You're watching Dukascopy TV. I'm Elaine Stenson and I'm joined in the studio now by a regular guest, independent market strategist Bruno Estier, who's here with us now to look at some technical analysis of the markets. Bruno, you're very welcome. So there's some panic in the equity markets at the moment. How bad is it?
Well, at first sight, it looks bad because we are moving on the VIX, which is the fear index, above 20%. And it's not going to continue too long if we take a longer-term view on the weekly charts. We saw that even though we've broken a downtrend line around the 20%, the magic 20%, the previous time before, in 2013, the fear index stopped around 22%.
And is the panic going to get worse, do you think?
Well, not really, because we think that already it has been contained for now 12 months between 11 and 22%.
Okay, so what are the risks for the equity markets?
The risk of the equity market is already gone. We are down on the weekly charts for 3 weeks in a row. The momentum is coming down as well. Some red trend lines, support trend line have been broken, also longer term ones. And basically what's going to happen is probably a test of the 40 weeks moving average in that direction. But that's just the short term. We need to look a bit closer to see what happened. We see yesterday a very big move of 2% down. This 40 weeks moving average is coming around 1710, 1730. And we see also these different Fibonacci numbers. And these are usually levels where the market can stop between the last rise from 1646 to 1850. And this area of 1723 is supposed to be an area where there should be some support.
Okay. And it seems very global, even in Japan.
Yes, it has been global. It has been triggered basically by fear in the emerging market that has affected also the two good performing markets, the US and the Japanese market. Here also we see a trend line which is broken, but we expect that our clouds, which are our longer term moving average, is going to offer support, and that a rebound will occur in the later part of the Q1.
Okay, but what can be done instead of waiting for a rebound?
Well, that's a very good question, because there are subsectors in the US equity market which are doing better than others. One of them is technology. As we see here, even with the 2% move on the S&P yesterday, we are only above the December low, while we are on the big index much lower.
Yes.
And we see also on the upper part of the panel the relative strength of the sector of technology relative to the S&P 500, which is rising. So there are pockets of safety, basically. The second pocket of safety is for example, healthcare, where here we have a rising relative strength, even making new highs, and we are relatively well above the December low. So there are basically sectors where we can look for a place to hide. These are so-called, in that case, that's a typical defensive sector, but it's not all of the defensive sector are the sector to hide. We saw the technology is also a good sector to stay.
So and this is safe.
And these are safe sectors,
yeah.
Yes. And it's probably better than just trying to go and pick bottoms, for example, on gold. Okay, we had a big downtrend on gold, and now it rebounds, but it remains relatively well in a downtrend. So it's always better with technical analysis to stay with the strongest things. And we have seen two examples with technology and healthcare.
Bruno, thank you so much for joining us in the studio today.
You're welcome.
And that's all we have time for now, but do check back later for further updates and interviews from the TV team. Bye for now.